Hello there. In this episode, we're going to look at a sleeping beauty. No, not a Disney princess, but a sleeping giant beginning to awake. I'm actually talking about the Japanese economy. A prominent Japanese economist once predicted it would take 30 years for his economy to emerge from the lost decades that began in the 1990s. Well, 30 years down the line, and here we are. But will the prophecy now come to pass? We're going to dig deep into the data to find out if Japan is finally waking up and what it could mean for the rest of the world. Welcome to IC Your Trade Extra. I'm your host, Alex Holmes from Oxford Economics. IC Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Okay, what we're going to do is look at a series of 3 charts that explains exactly what is going on here. If you're listening to audio only, don't worry, I'll talk you through the data, or you can take a moment now to switch on the video screen. So what you're seeing in this first chart is the minimum wage in Japan. Wage growth has really regained its vigor in 2023. Indeed, it's at a pace not seen in decades. For context, pay in Japan has been super sluggish since the 1990s. But eyebrows were raised recently this year when the annual spring wage negotiation with the unions, or shunto in Japanese, resulted in the biggest increase in the last 30 years. All eyes are now on the next round of negotiations in March, which actually isn't too far away now. How could it go? Well, there are 3 big factors to look at. First is the level of labour market tightness. That governs how much bargaining power workers have. Second, current inflation. That governs what they're going to bargain for. And third is corporate earnings, which governs what firms can afford to pay. All of these things are actually flashing amber or red at the moment, suggesting next spring's settlement could be another whopper, or at least a whopper by Japanese standards. But let's just rewind a minute. Why are we talking about the vagaries of Japanese wage negotiations? Well, the Bank of Japan, or BOJ, regards sustainable pay increases as one of the prerequisites for unwinding its ultra-loose monetary stimulus. That's already started in baby steps at least. This second chart is from the BOJ and shows its yield curve control model. Earlier this year, the BOJ said it would approach its policy with greater flexibility, which is the strongest signal yet that Japan may be moving closer to unwinding its super easy monetary policy. How that unfolds could have major implications, not just financial markets in the world's 3rd largest economy, but those worldwide too. What do I mean by that? Well, firstly, it could have big implications for the world's 2nd most traded currency pair, the dollar-yen. As this 3rd chart shows, the yen has really taken a big plunge this year, and that's to do with the yawning gap between interest rates in Japan versus those in the rest of the world. If you can earn over 5% in the US but pretty much 0 in Japan, it's pretty obvious which currency you're going to want. But if the Bank of Japan starts to normalise policy next year, at the same time as the Fed starts cutting, that gap could narrow, and the yen could swing back the other way. Secondly, ultra-low interest rates have for decades meant that Japanese capital has scoured the rest of the world for yield. That has meant huge sums of money flowing out of Japan and into foreign bonds, equity markets, real estate, and infrastructure. But if yields in Japan rise and Japanese investors no longer have such big eyes for overseas assets, what then happens to the price of those assets? Well, that's a question deserving of a whole other episode, but suffice to say, it's a question that has got many people scratching their heads. So, we've established monetary policy in Japan is important. Now let's go back to the big question, what is actually going to happen? Well, it's really about whether the BOJ judges the growth in wages and inflation to be durable or not. Even if wage growth has indeed shifted to a new higher trend, it may not be strong enough to improve real household incomes and boost consumption sufficiently to raise inflation from the demand side. Plus, inflation expectations are very sticky. Japan has endured decades of near-zero price rises, and research shows that inflation expectations are overwhelmingly based on backward-looking factors there. The BOJ may well eliminate the negative interest rate policy next year, arguing that the economy is on track to achieve the 2% inflation target in the coming years. But if thereafter inflation struggles to durably stay at that target, as it well could, then that could well be it. Or we could be making the mistake of judging the future by the past and failing to spot a sea change in Japan's economy and hence its monetary policy. We really won't know for some time. But until then, you can guarantee that speculation will remain, and we could even see some big swings back and forth in financial markets ahead. That's it. Thanks for tuning in to IC Your Trade Extra. IC Your Trade is brought to you by IC Markets, a leading high-performance trading provider. Trade up to IC Markets. Thanks again, and I look forward to seeing you next time.